The US basically said, "We're done," and slapped tariffs like a block button, then pulled up to China's house like, "Yo, why'd you tax our stuff?" And China's like, "Dude, you started it." Then the US goes, "Okay, but like, can you still buy our soybeans?" Soybean exports to China, once worth $12.8 billion a year, dropped by over 97% in a single week in March, from 73,000 to 2,000 tons. So why would the US throw its best-selling crop under the tractor like that? Tariffs are meant to protect struggling industries, the kind with rusty factories, $30 an hour union jobs, and machines from the Cold War that China replaces with five workers, a robot, and a lunch break. Think Detroit, think steel, think your uncle who used to build car parts and now drives Uber. So, tariffs on the steel industry? Sure, keep your union jobs. Appliances? Sure, textbook trade war. But soybeans? Those are not struggling. They're a US export beast. No one in the US really eats soybeans, but the land with one big star and four tiny stars? Yeah, that one, China. They buy over half of US supply. So putting tariffs on soybeans, that's not protecting an industry. That's like nuking your top customer and asking why they aren't buying from you anymore. Because here's a twist. It wasn't about soybeans. He's just a little bean. This was about something much bigger, at least according to Trump. Three words: China trade deficit. In 2025, the US was still importing way more from China than it exported, nearly a $300 billion negative current account. This was like showing up to a potluck with lettuce and watching China unload a 12-course meal. What they sold? Electronics, machinery, stuff you can't just DIY with duct tape. What we sold? Soybeans, pork, easily grown, easily replaced. Oh, hi, Brazil. That imbalance made the US look weak in trade talks, like showing up to a sword fight with a salad. But this wasn't just about sad spreadsheets. This was about politics. A sign that US had gone from we build stuff to we buy stuff. Industrial decline, strategic vulnerability, the American economy in passive mode. And nowhere felt this more than the Rust Belt. The industrial Midwest, Ohio, Michigan, Wisconsin, hammered by factory shutdowns after China joined the WTO. These are Trump's people. And tariffs? Basically his version of a hug. If hugs came with a 25% import tax. Then came the fairness card. China was accused of playing dirty. Subsidies, IP theft, forced tech transfers. Also, they still hold $800 billion of US debt. Kind of awkward when your economic rival also holds the receipt. So yeah, the tariffs came back. Part economic move, part political chess. Well, again, in game of chess, sometimes you sacrifice a pawn, and in this case, that pawn is in overalls, driving a tractor, and trying to figure out why no one's buying his soybeans anymore. Quick briefing on the tariff situation if you don't already know. US goes slap, China goes slap, US slap, big slap, China big slap. Because nothing says diplomacy like dueling Excel sheets and agricultural annihilation. A truce started on May 14th, where US tariffs have stabilized at 30% and China at 10%. So we're in a 90-day pause, which sounds promising and great for my stocks, but let me explain why. For soybean farmers, the ship has already sailed, and it's going to Brazil. All right, here's what usually happens with tariffs. Say the US slaps a 10% tariff on imported electronic toothbrushes. You know, those $100 ones that track your molars. So that tariff adds $10. Now, you'd think the seller just jacks the price up to $110 and moves on. Sure, the consumer does pay more, and the Chinese seller sheds a tear. Prices just aren't as competitive, but the consumer doesn't pay $10 more. Rather, it's slightly less, thanks to something called terms of trade. Basically, when you're a big chunky economy like the US, you can throw enough weight around to actually change the global price tag. Fewer Americans buy overpriced mouth sappers leads to less global demand, which drops prices. So instead of this, you get this. Congrats, you're still brushing like Iron Man, but for 550 less. So that's the logic. You get tax money from the foreign country, reduce foreign selling influence, and only marginally inconvenience the consumer. But soybeans are different. Unlike, say, a Boeing jet, China can replace them fast. So when the US plays tariff chicken, China's like, cool story, bro. We'll buy from Brazil. They slap tariffs on US soy, but don't need to buy it. So their consumers don't pay more. They just go AFK. And just like that, America's second biggest crop loses its biggest player. Oopsies. Farmers are left holding a mountain of soy, knocking on the doors of US grocery stores like, hey, you guys want some beans? Half off. buy one, get 20. Meanwhile, the average American is like, is that a new Starbucks flavor? Domestic supply piles up, prices crash, and farmers start Googling, can I eat 10 tons of soy by myself? So, yeah, tariffs on toothbrushes, maybe you pay a little more. Tariffs on soybeans, farmers cry in cornfields. In short, 1. China retaliates with tariffs. 2. They protect their consumers by buying elsewhere. And 3. They lock in Brazil as its new soybean BFF. Win win win. For China, that is. After China cut U.S. soybean imports by 97%, sales flatlined in America. America texted, you up? And China responded with, new number, who dis? Even with the 90-day truce by May, sales were still at zero. 1 week, May 22, looked promising though. Exports even beat 2024 numbers. So, did tariffs really matter? Yes, momentum from early 2025 was gone, and overall sales were still way down. Sure, soybeans are global and always in demand. If China's desperate, it'll pay. But one good week doesn't undo months of chaos. By late June, exports were back at zero. China's not rushing, and here's why. Brazil had already ramped up ports, railways, and long-term deals with Chinese buyers. So when the 145% tariff hit, Brazil was ready to step in. And China doesn't just buy beans, it builds supply chains. And once a crushing plant flips to Brazilian soy, it's not flipping back. In March 2025, China imported a record 14.68 million tons of Brazilian soybeans. By mid year, Brazil had fully replaced the US as China's top supplier. Trust, consistency, and shipping patterns matter, and America broke all three. This diversification extended beyond soybeans. These were the following markets that China diversified to. Argentina and Russia expanded grain exports to them. Brazil gained ground in beef and poultry. Canada captured more of the pork market, aided by favorable trade terms. Trades like dating. Walk away and someone else slides in. Beyond the politics and number crunching were the farmers, toiling in the soil, holding the short end of the stick. Soybean exports support over 270,000 American jobs. And when China left, what do you think happened to those people? Out in the fields, the soybeans stretched for miles, thick with promise, ripe with potential. But the promise was hollow. When China exited the market, the buyers vanished. Prices collapsed. Silos brimmed with beans no one wanted. And yet, farmers kept planting, knowing they'd likely lose money on every acre. But they had no choice. Planting was the only way to qualify for crop insurance and federal aid, which meant even a losing harvest was better than no harvest at all. So they adapted. Farmers rationed fertilizer, delayed upgrades, and planted safer crops. The government offered emergency aid, direct payments, loans, and insurance. But that was not enough. In the end, the core problem remained. There were simply not enough buyers. But not all is lost. The soybean sector may be struggling, but it can take a cue from pork, which was affected in similar fashion, but was able to recover quite spectacularly. Rather than relying on China, US pork exporters set records in places such as Colombia and Malaysia. Diversification works, and for soybean farmers, it might be the only way forward. Thank you.